Bonds can be a great way to earn interest on your cash. They are like loans you can buy from a company or government. The bond issuer, the company or government, pays you interest, which is how much it earns on the bond, and eventually returns the principal, the amount you invested. But after that basic knowledge, things get tricky. You might have heard that some bonds pay better than others, but what does that actually mean? How do you compare different kinds of bonds and find out which ones pay the most? The different types of bonds pay different amounts. Municipal bonds, for example, pay the most because they are considered to be low-risk investments and are backed by state or local governments. Corporate bonds fall in the middle, while government bonds tend to pay less than either of these two categories but more than high-yield corporate or junk bonds, or junk for short. The more risk you take on your investment portfolio and therefore the higher rate of return you expect from it, the more likely it is that some of your holdings will lose value over time. This video will explain everything you need to know about comparing bond payouts, so that you can pick the best investments for your financial strategy. Number 1. Municipal bonds. Municipal bonds are issued by state and local governments. These bonds are exempt from federal income tax, and they may also be exempt from state and local taxes. The interest on municipal bonds is not subject to federal income tax, so you can invest in them without worrying about losing money to the IRS. Number 2. Corporate bonds. Corporate bonds are issued by companies, but they're a type of debt security. This means that you're lending money to the issuer in exchange for interest payments and repayment at maturity. Corporate bonds are rated by credit agencies. This allows investors to see how likely it is that they will get their investment back, and with interest. Corporate bonds have variable interest rates that move up and down based on market conditions and other factors, unlike U.S. Treasury securities, which have fixed rates that don't change over time. Because the riskier nature of corporate bonds means there could be more volatility in your portfolio over time than with treasuries, and because these securities come at higher yields, it can be tempting to invest in them over treasuries if you're looking for higher returns on your investments after tax-free municipal bond limits have been reached. Number 3. Treasury bonds. Treasury bonds are issued by the U.S. Treasury to help fund the federal government. They are considered to be among the safest investments in the world because they are backed by the full faith and credit of our country, so you know that you'll get your money back if something happens to it. Because they're considered so safe, Treasury bonds have a fixed interest rate and can only be bought in increments of $100, or multiples thereof. Because these securities pay interest twice yearly on their maturity date, which is when you get paid back, there's no need for an issuer or underwriter. The US government handles everything themselves. Number 4. Government bonds. Government bonds are issued by the government. They're considered to be the safest bonds, so they pay a lower interest rate than corporate or private sector bonds. Government bonds are very liquid, meaning they can be bought and sold easily on the secondary market. This makes them ideal for investors who want to hold their investments for a long time period, more than 1 year. Government bonds don't have default risk, because governments always make payments when they come due. They're never technically late on payments like some companies can be during times of financial distress or bankruptcy proceedings. Number 5. Floating rate bonds. Floating rate bonds are bonds that have a variable interest rate. The interest rate on floating rate bonds is tied to a specific index, such as LIBOR or Euribor, the London Interbank Offered Rate. This means that it can change over time as the market shifts, but it won't be tied directly to inflation like fixed-rate bonds are. The downside of this type of bond is that if rates go up significantly in your country and yours doesn't increase at all, or vice versa, then you'll lose out on some potential gains from other investments like stocks or real estate. However, if you buy into a high enough interest rate with floating rates, then there's still plenty of room for profit, especially if you plan on holding onto them long term. We hope this short video guide has helped you learn more about the different types of bonds and how they work. We also want to remind you that if you're not sure what kind of bond would be best for your needs, it's always a good idea to talk with a professional financial advisor before making any investments.